Most people think owning a bank means owning a big building full of money and a giant vault. That is not true. The real prize when you buy a bank is something completely different. It is the deposits, the everyday money that normal people leave sitting in their accounts. Let me explain how the economics actually work. When you deposit money in a bank, the bank does not just lock it away. It pays you a very low interest rate, often under 1%. Then it takes that same money and lends it out to other people and businesses at a much higher rate, 6%, 7%, or more. The difference between what the bank pays you and what it charges borrowers is called the net interest margin. That small percentage, when applied to hundreds of millions or even billions of dollars, becomes the main source of profit. On top of the interest, banks earn money from fees. Account maintenance fees, overdraft fees, late payment fees, credit card fees. These fees are quiet, consistent, and very profitable. But the most powerful part of the model is leverage. Banks do not need to own all the money they lend. They are allowed to hold only a fraction of it as reserves. This means they can control and earn returns on far more money than the actual capital the owners put in. When the system works, the returns can be excellent. When confidence breaks, the same leverage becomes extremely dangerous. This is why banks can report massive profits in good years and still collapse very quickly when too many people try to withdraw their money at once. Owning a bank is not like owning a normal company. You are buying the legal ability to take other people's money, pay them almost nothing for it, lend it out at a higher rate, collect fees, and keep the difference. The building and the vault are just the visible part. The real asset is the deposits and the government permission to create credit. That is the true economics of owning a bank. Most people will never own one. But once you understand how the model really works, you stop looking at banks the same way forever.